Healthcare and technology are two of our long-term themes. Tech, because a lot of the innovation we've talked about, and healthcare due to demographics. We have an aging population that's going to need more healthcare. Healthcare underperformed last year, and so I think that could be attractive for over a long-term horizon. Also, a lot of the technology gains were in the big companies. We've talked about the Magnificent Seven. So I think there could be opportunities in small and mid-cap tech. That's certainly something Jim can talk about. We are, as Steve said, cautious on international stocks. China has challenges with, a bloated real estate sector, challenging demographics long-term, political crackdowns. But also on the fixed income side, and I'll see what Steve says here in a second, I like longer term high quality bonds here. There's a lot of cash still sitting in money market funds. Those yields will go down as the Fed starts cutting, and eventually they will cut. If rates have probably peaked, and we think they likely have for long-term rates, this could be a good time to lock in some of those long-term rates. And I would do it with higher quality bonds. I don't think you're getting paid a lot for taking too much credit risk. And another area that I would look at, speaking of high quality bonds, in taxable portfolios would be municipal bonds. They offer some pretty attractive long-term yields in this environment.
Steve, anything to add?
Yeah, certainly. There's always opportunities in markets, whether they are going up or down. We've talked about it. Markets have been driven by a few tech names, very large tech names, so-called Magnificent Seven. Valuations are high there, meaning that the stock prices are more expensive relative to what these companies earn. I think there are opportunities to the other 493 members of the S&P 500. And this includes value stocks, which tend to be a little bit less growth-oriented and less expensive relative to other stocks. I think to really get that part of the market going, we need rate cuts by the Federal Reserve, and then a strong economy that is sustainably broadening and strengthening, but not too hot so that inflation comes back. And then David talked about this, fixed income yields look very attractive, especially relative to the past 15 years. So there's an opportunity to move out of short-term instruments like cash, where rates would fall immediately when the Fed starts cutting, and you can lock in higher long-term yields. So we would favor higher quality parts of the market, like investment-grade corporates, or as you mentioned, municipals.
And there have been tremendous flows into money market assets. About $3 trillion of excess money market assets are kind of sitting on the sidelines right now. And last year, our own money market fund had over $1 billion of net inflow. So a lot of folks are in that money market space. Again, as the Fed starts cutting, you have that reinvestment risk where those rates will come down. It could be a good time to look at locking in some of those longer term rates.
Yeah, and I'd echo what Steve said, right? That regardless of the macro environment, we're always seeing opportunities here. Some investors may paint small caps with a broad brush, but they tend to miss out on companies positioned for outperformance there. As sentiment changes, it really provides us opportunities to find quality businesses that are attractively priced with long runways for earnings growth.